Not all dividend stocks deserve a spot in your portfolio. Some are just dead weight dragging down your returns. They might look safe, but behind the scenes, they're bleeding value and killing your income potential. If you're holding these, it might be time to cut them loose. I'll show you the red flags to watch for and how to upgrade your portfolio without losing sleep. This one move could put you miles ahead on your path to financial freedom. Part 1. High yield, high risk, the dividend trap. You see a stock with a 10% dividend yield and your first thought is, jackpot. But hold up, this might be the biggest trap in your entire portfolio. Let's break this down. When a stock's price crashes, its dividend yield shoots up, even if the company is falling apart. Think about it. If a company used to be $100 a share and paid a $5 dividend, that's a 5% yield. But if the stock tanks to $50 and keeps paying the same $5 dividend, boom, 10% yield. Sounds great, until you realize the business is in decline, bleeding revenue, or piling on debt just to keep those payouts going. This is the dividend trap. You're not getting a bargain, you're catching a falling knife. Stocks like Dow and LyondellBasell recently had yields near 10%, but only because their prices collapsed by nearly half. That's not income. That's a warning signal. And if you chase yield without checking the engine underneath, you're heading straight for a dividend cut, or worse, a total wipeout. And don't let the flashy yield fool you. A company paying out more in dividends than it earns in profit is burning cash, not building wealth. Look at the payout ratio. If it's pushing 100% or more, that dividend is living on borrowed time. So what's the takeaway? Don't fall for the siren song of sky-high yields. Instead, audit your portfolio. If the yield looks crazy high, dig deeper. Is the company actually healthy? Or is the yield just a symptom of a stock that's crashing for a reason? Next up, even worse than high yield? Declining earnings. We'll show you why profits are the real power source behind every safe dividend, and how to spot the fakes. Part 2. Stocks with falling earnings trends. So maybe the yield looks okay, and the payout ratio isn't sky high. But here's a killer you might be missing. Falling earnings. A company can only pay consistent dividends if it's making consistent profits. Simple, right? But too many investors ignore this. If earnings are dropping year after year, that dividend is on life support. It's just a matter of time before management pulls the plug. Let's make it real. Walgreens had a reputation for being a solid dividend stock. But as earnings shrank and financial stress mounted, they recently suspended their dividend entirely. That's a gut punch for income investors. The signal was there for years. Earnings sliding, profitability getting squeezed. Yet many holders didn't act until it was too late. Here's the truth. Dividends aren't magic money. They're a slice of profits. If profits go, the dividend goes. And if a company keeps the dividend going anyway, they're either raiding reserves or taking on debt. That's not stability. That's desperation in disguise. Watch the earnings trend like a hawk. Are revenues shrinking? Is net income down 2, 3, 4 quarters in a row? If yes, that dividend is living on borrowed time. Don't wait for the press release. By then, the stock's already tanked, and you're stuck holding the bag. Coming up next, even if earnings look stable, heavy debt can quietly destroy a dividend. We'll expose how rising interest rates are turning debt-loaded dividend stocks into financial ticking time bombs. Part 3. Debt-loaded companies. You might think your dividend stock is safe, but if it's drowning in debt, it's a ticking time bomb. Let's talk about the silent killer in your portfolio. Leverage. When a company's debt-to-equity ratio climbs above 2 to 1, it's flashing red. That means for every dollar of equity, they owe 2 in debt. Sure, that might have worked when interest rates were near zero. But today, debt is expensive. payments balloon, earnings shrink, and guess what gets cut? That dividend you were counting on. Just look at AT&T. It was once a staple in dividend portfolios. But as its debt piled up and rates rose, the company slashed its dividend, and investors paid the price. The stock tanked, income dried up, and anyone holding on got burned. Here's the real danger. Debt doesn't just threaten the dividend, it chokes flexibility. A debt-loaded company can't innovate, can't adapt, and definitely can't protect your income in a downturn. It's like trying to run a marathon wearing concrete shoes. So how do you avoid this trap? Simple. Audit your holdings. Check the debt-to-equity ratio. Anything north of 2-to-1 should raise eyebrows. Look for strong cash flow and a management team that plays defense as well as offense. Because a juicy yield means nothing if the business is financially fragile. Coming up next, even if the balance sheet looks okay, there's another silent threat: being stuck in a dying industry. We'll show you how to spot these dividend zombies before they drag your portfolio into the grave. Part 4. Zombie stocks in dying industries. Some dividend stocks look fine on the surface. They're still paying, still moving, but underneath, they're already dead. Welcome to the world of zombie stocks in dying industries. These are the companies clinging to old business models, slowly bleeding relevance, revenue, and eventually, your returns. Let's start with a familiar example. Legacy telecom giants like AT&T and Verizon. These were once unshakable pillars of dividend investing. Stable, dependable, set it and forget it kind of stocks. But not anymore. Between outdated landline businesses, massive debt loads, and fierce competition from newer, leaner players, these giants are now dragging their feet through quicksand. In 2022, AT&T slashed its dividend by nearly 50%. That is not a small trim. That is a giant red flag. And while they are trying to pivot and restructure, the market is not waiting. Declining revenue, outdated infrastructure, and massive capital obligations mean that the business model itself is under threat. Next, let's talk malls, specifically mall-based REITs like Macrick and Tanger Factory Outlet Centers. Sure, they may still be cutting dividend checks, but let's be honest, retail foot traffic is fading fast. E-commerce isn't slowing down, and empty storefronts don't pay rent. What used to be steady real estate income is now a high-risk gamble on whether brick-and-mortar retail can survive the digital age. So here's the truth. A dividend isn't safe just because it still exists. Some companies are paying you while quietly sinking. And unless you're checking the pulse of these businesses, you won't know they're dead until it's too late. Next up, how do you actually spot these zombies before they infect your portfolio? We're diving into the key financial metrics that expose dividend traps before they bite. Part 5. Identifying dividend traps through financial metrics. Here's how to know if your dividend stock is paying you now, but setting you up to fail later. Just because a stock pays a dividend doesn't mean it's safe. The real signals are buried in the numbers, metrics that too many investors ignore until it's too late. Let's break them down so you can spot a dividend trap before it poisons your portfolio. First up, the dividend payout ratio. This shows how much of a company's earnings are being handed out to shareholders. If the ratio is over 100%, the company is paying more than it makes. That's like trying to live on a credit card. And eventually, the bill comes due. A healthy range, somewhere under 60%. That gives room for reinvestment and flexibility in bad years. Second, the dividend coverage ratio. This tells you how comfortably a company can pay its dividend from net income. If it's under 1.5, watch out. That means the dividend is barely covered, and one weak quarter could flip the switch from reliable payout to silent account. Third, free cash flow, or FCF. This is the gold standard. Earnings can be padded with accounting tricks. Cash flow cannot. A company with declining free cash flow is bleeding out. And that dividend? On life support. Fourth, debt levels. Check the company's debt-to-equity ratio. If it's above 2 to 1, you are looking at a heavily leveraged company. In a high-interest rate environment, that debt becomes a monster. And when cash gets tight, dividends are usually the first thing on the chopping block. Fifth, dividend growth rate. Is the dividend flat? Has it been cut? Or is it growing steadily year after year? Strong, consistent growth signals a healthy, confident company. Stagnation or cuts mean the opposite, so don't fall for the trap of high yield alone. Ask, is this dividend built to last? Next, we'll pit so-called safe dividend stocks against true wealth compounders and reveal who really deserves a spot in your portfolio. Part 6. Comparing safe versus wealth building. Dividend stocks. You might feel good seeing fat dividend checks roll in, but are those checks growing your wealth or quietly holding you back? There's a huge difference between safe dividend stocks and the ones that actually build wealth. Let's break it down. First, the high yielders. Stocks like AT&T and Verizon often look irresistible. Big payouts, steady cash. But here's the problem. High yield usually means high risk. Why? Because those yields are high for a reason. Most often, the stock price has been dropping, and in many cases, that drop is tied to a business in decline. Take AT&T. Yes, the yield is high, but it's also drowning in debt and has cut its dividend before. And the stock? It's gone nowhere in years. If your goal is income now, fine. But if you want growth and long-term wealth, that kind of stock could be a dead end. Now let's talk about the wealth builders. Dividend compounders like Johnson & Johnson or Procter & Gamble. They might not offer flashy yields today, but their dividends grow every single year. And that growth adds up, fast. Over time, what starts as a 2% yield could turn into 10% on your original cost, just through consistent increases. Plus, their stock prices tend to grow too, so you're winning on both fronts. And here's something most investors overlook: sector over-concentration. Loading up on financials or utilities might boost yield short-term, but it limits your upside and increases your risk. A real wealth-building portfolio spreads across sectors, finds financially strong companies, and focuses on long-term earning power, not short-term gimmicks. So here's the bottom line. Income today is great, but income that grows every year? That's what builds real freedom. Up next, we'll look at the tax traps and smart strategies that can make or break your retirement income. Part 7. How to replace weak dividend stocks. So you found the underperformers, the dividend zombies, the high-yield traps. Now what? It's time for a portfolio cleanse. Think of this like spring cleaning, but for your financial future. If your dividend stocks aren't pulling their weight, you owe it to your goals to upgrade them. Here's how to do it right. First, build your dividend checklist. This is your new standard for what belongs in your portfolio. Dividend growth rate. Is the company growing its dividend every year? Consistency is key. Look for 10+ years of uninterrupted increases. It shows discipline and strength. Payout ratio. If a company is paying out more than 65% of its earnings, that dividend might be living on borrowed time. Strong companies leave room to reinvest and grow. Earnings stability. You want to see smooth, rising earnings over the past 5 to 10 years. Erratic income? That's a red flag. No earnings growth equals no dividend growth. Debt levels. If the company's debt-to-equity ratio is sky-high, that dividend might be on thin ice. A healthy balance sheet gives room to breathe, even during recessions. Industry positioning. Is the company in a dying sector or a growing one? Dominant players in expanding markets tend to reward shareholders longer. Once your checklist is clear, schedule a portfolio audit every 6 months. Literally, set a calendar reminder. If you've made it this far, I've got a powerful dividend portfolio cleanup guide just for you, and it's completely free. Inside, you'll find a checklist to spot underperforming stocks, warning signs to watch out for, and smart tips to refresh your portfolio for stronger income. Just comment "Clean Up" on this video. Once we hit 50 comments, I'll share the link so everyone can download it. Now that you've cleared out the dead weight, let's compare the heavy hitters. In the next video, we'll break down dividends versus cash flow machines to see which one builds wealth faster and which one fits your freedom plan best. Get ready to choose your income weapon.